Greetings for the day, dear students. Let us begin with the subunit 3.3 of descriptive analytics of financial statements. So in previous class, we have discussed about the 3 units, that is up to 3.2, including introduction of financial statements, elements of financial statements, and ratio analysis. In ratio analysis 3.2 of subunit 3.2, we are completed with the classification of understanding of classification of ratio analysis. Now let us go with the one practical example of ratio analysis, that the classification where all we are using, how we are using, and when and how we are using, and what will be the impact, how we are going to calculate. Okay, so I am sharing my PPT. I hope my video is visible to you all. So subunit 3.4, unit 3.4 tells us on exercises on ratio analysis. So we are practicing on the subunit of 3.4, that is exercises on ratio analysis. So here I had pasted one balance sheet. Okay, one balance sheet is there of Nishnath Limited. Of Nishant Limited is one of the balance sheet which are given as at 31st March 2021. So they're given certain balance sheet. This is how the realistic balance sheet will be appear on the in a company. So you can see the left hand side there is a liabilities and the right hand side assets. Okay, so the first under liabilities which all will become, that is equity share capital, that is 5 lakh rupees, 8% preference share capital 4 lakh rupees, reserves and surplus 4 lakhs, 9% debentures 6 lakhs, and current liabilities are having 4 lakhs. So assets, and you can see the assets. So the other side assets are there: land and buildings 9 lakh, plant and machinery 8 lakh rupees, closing stock 3 lakh rupees, debtors 2 lakhs, bank and cash 90,000, prepaid expenses 10,000. So here the 23 lakhs each side it will be getting tallied, which means the assets are equivalent to the liabilities. Now let us move for the additional information which is given for this exercise. So sales during the year 8 lakh rupees. So during the year they made a expenses, they made a sale of rupees 8 lakh and they earned the revenue. Next, cost of goods sold. So for that sales which they earned, the cost is rupees 6 lakh rupees, they earn the cost. Next, office and administrative expenses, they beared the office and administrative expenses 1,12,000 altogether. And next, commission and discount earned is rupees 12,000 on their sale and on their purchase of the machine, purchase of the raw materials. Next, loss on sale of machinery. So they failed, they had a loss on selling of their one of their machinery of rupees 34,000. And next, profit on sale of building. So they sold one building on which they earned the profit of rupees for 54,000 rupees. Now there is a question that we have to require to calculate current ratio, liquid ratio, stock turnover ratio, gross profit ratio, operating cost ratio, net profit ratio, debt equity ratio, solvency ratio, fixed assets ratio, fixed assets turnover ratio, and proprietary ratio. So these all are were given by the company called Nishant Limited. So this is a practical example. So let us go for a solution one by one. So first we are going to calculate the current ratio. So here this is how the calculation will be made. Calculation of ratios with the help of balance sheet of Nishant Limited as at 31st March 2021. Okay, you can see that the first they asked us to calculate current ratio. So we'll go one by one accordingly. So current ratio, the formula is, as we discussed in the understanding of classification of current assets. Below that I had given the formula also. So the formula is current assets divided by current liabilities. So the current ratio is equal to current assets divided by current liabilities. So what all current assets are there? Let us look into it. So the closing stock is there. That is a current asset, 3 lakh rupees. Debtors is a 2 lakh rupees. That is also current assets. Bank and cash is also a current asset, 90,000, and prepaid expenses we had, that is also 10,000. So this is altogether will become 6 lakhs divided by 4 lakh is a current liabilities, which is altogether they are given here. You can see. So this is the current liability. Okay, so after dividing, first we will include all the current assets. If they segregated the amount, we'll take all the amount, we'll add together, and later we'll go for the total amount divided by the total liabilities. Even though if they are not given any current liabilities, so if they given any current liabilities as a current assets subdivided values, so we'll do what we will add together, and later we will go for the total amounts. So here total amount is 6 lakh rupees divided by 4 lakh rupees is equal to what we found, 1.5 divided by 1. 1.5 divided by 1 after dividing the 6 lakh in the 4 lakh rupees. So we got 1.51 is to 1, which means, so if we are paying, so for example, if there is a 1 rupee liability, then we have a 1.5 rupees to pay off. Means rest of the 0.5 value rupees will be our what? Our income, we can say, or our profit. Okay. So this is about the current ratio. Okay. Next is, as while discussion, I said that I told you that how the current ratios satisfaction level will be there. The satisfactory level of current ratio is 1 is to 1. So if it is more than that, then it is a very much satisfied. Next is liquid ratio. So what is the value? What is the next important ratio they ask us to calculate is liquid ratio. So the liquid ratio tells about that. What do you mean? The liquid ratio is equal to liquid assets divided by liquid liabilities. Liquid liabilities or liquid assets we can also say, or we can also say that quick assets and quick liabilities, which are having a very short duration of time where we can convert into the cash. Okay, like for assets, for like cash at bank or deposit at bank. So that will be what our liquid asset. Okay, so let us see what is the value will be included. Here the debtors which can be converted into liquid, the 2 lakh rupees, and next bank and cash. So the cash is kept into bank, and also they are having certain cash in their hand. And next prepaid expenses which can be retained at any time. Prepaid expenses in the sense we are early paid the expenses which can be reimbursed at any time. So that altogether will become 3 lakh rupees. 3 lakh divided by 4 lakh. 4 lakh is altogether the given current liabilities. So here we don't know what is the liquid liabilities. So that's why we are taking the current liabilities total value or the total liabilities value, that is 4 lakh rupees. After dividing that, we got the 0.75 is to 1. So which means it is not a satisfactory level. It should be also 1 is to 1. Okay, it is actually satisfactory level. How I'll tell you, if we have a 0.75, we can use our current liabilities to pay off the liquid liabilities, right? Current assets we can use, and we can pay the liquid liabilities as well. So this is also a satisfactory level. Next is the third important ratio they ask us to calculate is stock turnover ratio. As you can see, the stock turnover ratio tells about that what is the cost of goods sold. Okay, the stock turnover ratio formula is cost of goods sold divided by average inventory cost, or else the other formula is cost of goods sold divided by closing stock. Okay, so the cost of goods sold they given in the additional information rupees 6 lakh, and the average inventory cost. Average inventory cost is that they given in the balance sheet, that is the stock value or else the inventory value. So that will be taken together. So 6 lakh divided by 3 lakh is equal to 2 times we can have the stock turnover ratio. Means if we have a stock, we can get the turnover at a 2 times. So this is also satisfactory level. Next is gross profit ratio. So gross profit ratio is the gross profit divided by net sales into 100. So how much gross profit we are earning. So now we don't know what is the gross profit. So how we to calculate that? So whatever sales we are making and whatever the cost of goods sold are there, so deducting that, whatever the value will be remaining, that will be taken as a cost, that is will be taken as a gross profit. Okay, so gross profit, so net sales is, we are having 8 lakh rupees. In that we have sold cost, we sold the goods at a cost of 6 lakh rupees. After deducting that, we got a value of 2 lakh rupees, and total net sales is 8 lakh rupees. So deducting that, so after dividing 2 lakh into 8 lakh, which is multiplied by 100%, 100 is, it will become 25% of our gross profit ratio we are earning. So which means we are earning a great gross profit as well. Next is operating cost ratio. So the next important ratio they ask us to calculate is operating cost ratio. So you can see that the formula is operating cost divided by net sales into 100. So now we have to understand that what is the operating cost here. So we don't know if they're given, we can take directly. If they're not given, we have to calculate it by operating cost is equal to cost of goods sold plus office and administration expenses. Okay, cost of goods sold, at what cost we are producing, we are produce the goods, and what cost we are selling it, and what all expenses we are involved, that may be direct or indirect expenses, altogether we have to add. So that will be become the total operating cost. So after getting that, we have to divide it from the net sales, and we need to multiply it with the 100. So that will become 89%. So operating cost ratio is 89%, means we are getting the ratio, we are having the 89% of productivity in our businesses. Next is net profit ratio. So net profit ratio is also like formula is net profit divided by net sales into 100. So whereas you can see that the net profit will be calculated based on certain requirements, that is gross profit plus profit on sale of building plus commission earned, and next minus office expenses, and add in and all these together we need to deduct the office expenses and loss on sale of machinery. Whichever we earned, indirect income will be there. In that we are going to deduct all indirect expenses. So then only we are getting the net profit. Okay, so net profit will be calculated together after deducting net non-operating income minus non-operating expenses. We got 1,20,000 as a net profit, and we are deducting it 8 lakh rupees, that is net sales. So that, and multiplying with 100, so we got a 15% of the net profit. Okay, net profit ratio is 15% we got. So this is what the net profit tells us. Okay, next, which means we are earning 15% of net profit in our business, whatever we are doing a business. So in that, a business is earned 15% in the year of 31st March 2021. Next is the debt equity ratio. So debt equity ratio is how much we are having the leverage, how much debit we are getting, how much borrowings we are having, how much equity we are having. So that will also tells the debt equity ratio is equal to outsiders fund divided by owners fund. Outsiders funds in the sense it may be including debentures and liabilities. Okay, it will be including debentures and liabilities. So we can see that debentures are they given in the problem. So you can see debentures, 9% debentures are 6 lakh rupees, and the current liabilities are 4 lakh rupees. So altogether will become how much? Totally 10 lakhs it will become. And you can see, so 6 lakhs plus 4 lakhs divided by owners fund. Owners fund in the sense how much equity shares we are introducing, how much preference shareholders are there, and what is our reserves and surplus from the previous of running of our businesses. So altogether we include, so that will become our owners fund. So 10 lakh divided by 13 lakh, it will become 0.77 is to 1. So if it is 1% we are requiring, so we are getting 0.77, which is a mixture of debt equity ratio. Next is proprietary ratio. Proprietary ratio tells about that how much a proprietor is earning a profit. Okay, how much his contribution to the business, what will be his part of profit he is going to get. So in that, shareholders fund divided by total assets into 100. So this is the formula to use. So in that, shareholders fund, as already calculated, owners funds and shareholders funds are both are same. So shareholders fund we already calculated previously in previous ratio. So that we will take the same value 13 lakh rupees, or else we can take like this also 5 lakh rupees plus 4 lakh rupees plus 4 lakh rupees. That 5 lakh rupees is of equity share capital, 4 lakh rupees of preference share capital, and 4 lakh rupees of reserves and surplus. So total altogether will become 13 lakh rupees and divided by net assets or total assets. So total assets, what all assets we have? Let us see. So we have a land and building, we have a plant and machinery, that is 9 lakh, land and building is 9 lakh, plant and machinery is 8 lakh, total become 17 lakh. And next, closing stock of 3 lakh rupees, debtors of 2 lakh rupees, bank and cash 90,000, prepaid expenses 10,000. So all assets we take, total value is 23 lakh rupees. So after deducting, after dividing it, we got a 56.52% of proprietor is earning a revenue from this business, right? Next is fixed assets to net worth ratio. So how much we are getting the fixed assets from the to net worth ratio. So what will be the fixed assets and net worth ratio we are getting? So first we have to calculate with the fixed assets. The formula will be fixed assets divided by shareholders fund into 100. So here only we are taking the fixed long-term assets. So fixed long-term assets are like the land and building and the plant and machinery. So those are the two bigger assets. So you can see that value is 9 lakh rupees and 8 lakh rupees. So total will become 17 lakh, and the shareholders fund we already calculated, that is 13 lakh rupees. So here total percentage is 131% of net worth we are earning through the fixed assets. Okay. So next is solvency ratio. Solvency ratio in the how much long term our